Coinbase stock has been on a tear, up more than 100% since April and over 30% in the past week. And no, this time it isn't meme-fueled hype or some influencer yelling buy the dip. This time, the catalysts are real: government clarity, regulatory momentum, and actual policy shifts that matter. Now, if you're new here, I'm a value investor, which usually means I steer clear of the crypto hype. No meme coins, no NFTs. But Coinbase, it's different. It's a real business with real revenue, earnings, and cash flow. And today, we're going to break down exactly why the stock is booming, dig into the financials, and calculate what the company is actually worth. Let's jump in. So what is fueling the Coinbase moon mission? In my opinion, there are two clear things: legislation and innovation. First up, the US Senate has just passed a bill called the Genius Act. And no, I didn't make that up. It's a new framework to regulate stablecoins, the cryptocurrencies that are pegged to the US dollar. Think of it as crypto's version of getting a driver's license and finally being allowed on the freeway. And why does this matter? It's because stablecoins are Coinbase's second largest revenue driver. And this bill, with full reserve backings, audits, anti-money laundering checks, basically gives them the green light to grow. Secondly, Coinbase rolled out Coinbase Payments, a new platform that lets people use stablecoins like USDC to buy stuff online. And it's already live with Shopify, and Wall Street loved it. However, Visa, MasterCard, and PayPal, they dipped, while Coinbase shot past through its resistance levels like they weren't even there, now trading closer to $350. In just 1 week, CoinStock is up more than 30% and up more than 100% since April. Now, investors like us are asking the big question: did I miss the boat, or is there still a way to make money from Coinbase? To figure that out, we need to look past the headlines and dig into the actual numbers. For that, let's take a closer look at the financials of Coinbase. So as you can see, Coinbase is currently trading at around $344, and it seems like it has been on a roller coaster ride just over the last year, as it went from 200 down to 150, then up to 300, then again down to 150, and currently it's back at 350. Looking at their financial overview, Coinbase is currently trading at a high 64 PE ratio, with a forward PE of closer to 58. This indicates that the company might be highly priced. Now, they're currently trading at almost $88 billion in market cap, while their enterprise value is $84 billion, which basically means that they have more cash on hand than debt, which we can clearly see here because their net debt is negative $3 billion. Honestly, a nice thing to see. Now, strangely enough, their return on invested capital is only 4.4%. I would have expected at least mid-double digits from a company like Coinbase. This basically means that Coinbase is struggling to make good money on their investments. Now let's look at their revenue. In 2019, they did $500 million in revenue, growing that to over $6 billion in 2024. There was also this huge spike in 2021, which I will talk about more in the next part of the video. As far as net income goes, we see a similar picture as revenue, with a large dip in 2022, but last year they did $2.5 billion. Now let's look at one thing I do not really like about the company. It's their shares outstanding. As you can see, they are issuing shares every year, basically diluting their owners on the way. Now let's see what the analysts are predicting for the company. And this kind of surprises me because I expected much bigger growth from analyst predictions for their revenue. Analysts predict Coinbase to do around $7.5 billion in revenue in 2029, comparing that to the $6.5 billion they did in 2024. Honestly, that's not the greatest growth. Also, analysts predict that Coinbase's net income will basically stay flat for the next 5 years, going from $2.5 billion to 2.6. Again, not that exciting. Alright, let's break down what I found in Coinbase Financials. First, the multiples it's trading at are quite high, which often signals a lot of the optimism already priced in. While that is not always a red flag, it does raise the bar for future performance. Now, on the positive side, they have more cash on hand than debt, which is fantastic. It gives them financial flexibility and reduces the risk of bankruptcy, especially in such a volatile industry like crypto. But there's more downside too. They're issuing shares fairly heavily, which means dilution for the shareholders. Another thing that surprised me is the fact that their return on invested capital is under 5, lower than I expected from a company with Coinbase's brand and market position. Usually, when I look in a company, I prefer to see the return on invested capital to be in the double digits, because that means that the company is doing a good job at investing their own money. Now, yes, there's growth, but the strange thing is, analyst growth estimates are surprisingly low. And in my opinion, here's the likely reason why. Coinbase had a massive revenue boom in 2021, pulling in over $7 billion. But just a year before that, they were only making about $1 billion. And in 2022, the revenue dropped by over 50%, back down to $3 billion. So, what happened? If you line that up with Bitcoin's price movements, the issue becomes pretty clear. Coinbase's revenue tends to move with Bitcoin. In 2021, Bitcoin was on fire, reaching all-time highs, and at the same time, Coinbase revenue soared. But in 2022, when Bitcoin cooled off and the hype started to settle, Coinbase's revenue got sliced in half. Now, looking at this chart, it looks like we're back in a similar spot as 2021. And because of that, it wouldn't surprise me if Coinbase would have its best year yet in 2025. But if crypto stumbles again, history has shown Coinbase is extremely vulnerable to that downturn. Now, let's keep all that in mind when we calculate Coinbase's intrinsic value to see if a company could be a buy today. This is my intrinsic value calculator, and let's do two calculations, one optimistic and one pessimistic, and start with the optimistic one. So, in the last 12 months, Coinbase did around $5.32 in EPS. And let's say that the analysts are wrong and Coinbase will grow its revenue at 20% annually for the next 10 years. Also, if a company continues to grow at such growth rates, I would expect it to trade at a higher multiple. So let's give it an optimistic 40 multiple. If all of these numbers would come true, you can clearly see that for a 10% return, you could pay over $500 today. In fact, the current price is closer to 14.5% return. However, I do think that these numbers are highly optimistic. So now, let's say that Bitcoin starts to stagnate over the next 5 years, causing Coinbase revenue to follow. For that, let's say that for the next 5 years, they will grow at 0%. And let's say for the 5 years after that, Bitcoin receives traffic again, which would cause Coinbase revenue to grow at 20%. Let's keep the expected return at 10, and for the terminal multiple, let's give it the market average of 15. Now, as you can see, if all of these numbers come true, to get a 10% annual return for the next 10 years, you would have to pay $105 for Coinbase stock today. And to be honest, these numbers look more realistic to me than the ones we calculated in the optimistic calculation. So yes, the company is performing well at the moment. It has strong cash reserves and solid name recognition, and it's clearly benefiting from the renewed enthusiasm around crypto. But when you dig deeper, the fundamentals tell a different story. Coinbase is heavily tied to the price of Bitcoin, and in my opinion, that is the biggest issue. Their revenue, their growth, even their investor sentiment all rises and falls with the crypto market. And while Bitcoin is booming right now, it does feel like a lot of that upside is already priced in to the stock. Add in the high valuation, low return on invested capital, and ongoing share dilution, and you're left with a business that doesn't offer enough margin of safety. At least, not for a value investor like me. Personally, I would need to see the stock price drop by at least 50% or for something fundamental to change before I would even consider to take another look. And even then, I would see it as a high-risk investment that doesn't really fit my long-term philosophy. But what do you think? Do you think I'm wrong? Leave your comments down below. If you enjoyed the video, consider subscribing and clicking the like button, as it does help to grow my channel. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.